All right, welcome everybody. Apologies for that second screen. I'm not sure why the projector's not working, so please bear with me. Now, first of all, welcome back everybody. It's nice to see most of you back, which is always a good thing. From this week, lectures will be recorded, okay? So you'll see me making notes on screen like so, for example, like this one, and I might be highlighting things as we go along as well. So this will all be captured in the video, and I'll make that video available to you on UTS Online, okay? So please be mindful of that. The other key thing that I wanted to mention before we get into the class today is on the content. So the content that I cover in lectures and the content you see in the lecture slides, guys, that's the key areas I want you to focus on understanding. Okay, so let the lecture slides and what I talk about in class, let that be the key that guides you in terms of what you need to be knowing about this subject. Now, given I've got a restricted amount of time with you, you still do need to read your textbook, okay, but use the lecture slides and use the key areas and concepts that I talk about in the lecture to guide you as to what you need to know. So if there's a whole section of your textbook that we don't talk about at all, read it, but you don't need to go through it in too much detail, okay? Now, usually, if you remember from last week, I do walk around the front quite a lot. Because I'm using this device at the moment, I will be standing here for the majority of the class, but I might get up and move just a little bit. So you'll just have to focus, essentially. Okay, so on that note, let's get started. What are we going to be talking about today? Before we go into that, I wanted to show you this. So perceptions of auditing, if you haven't seen this before. So basically, different perceptions that different people have about what auditors actually do. So the first one that you see on the top left, that's what my friends think I do. This is what my mum thinks I do. What society thinks I do. What my partners or my bosses, what they think I do. This is my favourite, what I think I do and what I actually do. So there are a number of different perceptions of what audit actually entails, and we'll be going through that over the course of the semester. But the reason I wanted to also show this to you is, number one, it's kind of funny. Number two, it shows you the different perceptions of what people believe auditors do, and that's going to come in handy next week when I take you through a concept called the the expectations gap. So the audit expectations gap, and that's talking about the difference in expectations between what society thinks auditors do and what we actually do. So we will come back to that next week. So today we're going to be talking about why do we do audit in the first place? What's the point? Why is it there? And we're also going to touch on the end product, the final product of audit, which is the audit opinion. Now the audit opinion is given in the audit report. So we're going to talk about the different types of audit reports and touch on those just a little bit as well. At the end of today's class, I'm hoping I'm going to have enough time to allow one of your fellow students actually to give you a 5-minute presentation on a project or a competition that Microsoft is running at the moment, something that you might be interested in getting involved in. So Lydia will come and talk to you at the end of class, hopefully if time permits. So on that note, let's get straight into it. Learning objectives, guys, you can read that, so I'm not going to go through that in detail. What I want to do is to talk to you about a concept called audit and a concept called assurance. So this subject is called assurance services and audit. Now we focus on audit, okay? So the subject will be focused all on the audit process. Now what I want you to understand is that audit is only one type of a much broader concept, which is assurance services. So if you really want to think about it, this whole thing is assurance services, and one part of that, or one type of that I should say, is audit. So assurance is much broader and audit is just one type. Now, though our focus will be on audit, I want you to understand that kind of broader definition before we kind of zoom in on what our focus is going to be. So assurance is defined as, here we go, an assurance engagement is defined as an engagement in which an assurance practitioner expresses a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the outcome of the evaluation or measurement of a subject matter against criteria. Do we get that? Silence. Okay, that makes zero sense, and that's way too long. I had to stop for food and water halfway through reading that. So let's break this down. Now, the best way that I know how to do this for you, you have an assurance practitioner, aka the auditor for our purposes. You have an assurance practitioner coming in and looking at, oh, there's one more thing I want to add. So if you come over here right now, we've just mentioned that the assurance practitioner is the auditor. We've spoken about the responsible party. They are the group who prepare the information the auditor looks at. We've talked about the subject matter. That is the information the auditor is focusing on. And they are comparing that information against criteria in order to express a conclusion. So we've essentially captured all the main concepts here. There's one final thing. Ladies and gentlemen, we're going to do a little mind map, okay? Now, the focus, and to help you understand this, I'm actually going to give you the context of what we're going to be focusing on in this subject. So what I want everyone to do is actually copy this down. So the first thing I want to talk about, and I apologize, the handwriting on this thing is going to be very messy, but the focus, the context that we'll be focusing on throughout this subject is on the financial report. So write that down for me. So we're looking at the financial report, okay? That will be our focus. Now remember, our focus is on audit. So what the context is the audit of the financial report, okay? Now let's break this down a little bit. Please raise your hand for me if you've ever seen a financial report. Raise your hand. Okay, here's my question. Is it just a couple of pages long or is it quite extensive? It's very extensive. Now, the financial report is made up of two things. Can you tell me what they are? What's in there? Beautiful. So we've got the financial statement, so your income statement, your balance sheet, your cash flow statement, your statement of changes in equity. God, that's ugly. Anyway. And what's the other thing? What's the rest of the report made up of? Excellent. Notes. So write that down for me. And next to that, I want you all to write the word disclosures, notes and disclosures. Now, what am I talking about? The financial statements are where you find all your numbers. The notes and the disclosures, they're all the extra words that you see in a financial report. They're all the extra additional information that the organisation has provided in that report. So it's essentially just additional information to support what they have said in the financial statements. So what do you need to know? The financial report, guys, first and foremost, is made up of both of those things. You've got the financial statements as well as the notes. So when I tell you that the context, the focus that we will have is on the audit of the entire financial report, I'm literally talking about this entire thing, okay? Not just the numbers, also the words. All of this information, all right? Now, so how does it work? The auditor comes in and checks the financial report, checks all that information within that document that you are referring to, okay, which includes the financial statements as well as the notes. Now, what the auditor is doing is it's checking that information in order to ultimately come up with a conclusion as to whether that information is indeed true and fair. Is the information in the financial report, is it a true and fair reflection of the business? Is it a true and fair reflection of what has happened in the business? Okay, so you're going to hear true and fair quite a lot over the course of the subject. Now, in order to come up with a conclusion about whether it is indeed true or fair, the auditor needs to check this information. Let me just change this. So checking this information. How do they do that? Before I take you through that, I want you to know one thing. In assurance, the premise is always the same. You always have one person or one practitioner, let me show you something really, certain information. That information, ladies and gentlemen, I want you to write this down, is called the subject matter. Write this down. You need to understand the terminology, okay? So the auditor is coming in and checking information. The information is called the subject matter, okay? Now, they are checking that information to see if it's correct. in order to see that information, in order to conclude whether that information is indeed correct or not, we need to be comparing or evaluating that information against something. That something, and I want you to write this down as well, is called criteria. Oh, sorry, I'll do it down here, actually. One moment. Technology is great sometimes and very frustrating other times. Okay, here we go. So it's called criteria. Criteria is you can think about it as the rules or the things that we use in order to determine whether whether the subject matter, I'll use the correct terminology, the subject matter is indeed correct. Now come back to context. If we're looking at the financial report, so the financial statements and the notes, what is the criteria we are checking that against to determine whether it's true and fair? What do you think? Beautiful. Ladies and gentlemen, write that down. So the criteria in our case are the AASBs, the accounting standards. They are the criteria we are using to evaluate whether the financial report or that information, the subject matter, is indeed true and fair. Now, is everyone okay so far? Head movement for me. Just do it, just do it, just do it, just do it. Okay. Kids, now we're getting there. What the auditor does, so here we go, let's just recap. Auditor comes in, checks the information, aka subject matter, which in our case will be the financial report, checks that information or evaluates that information against a set of criteria, in our case the AASBs. And based on that, they collect evidence and they do testing in order to come up with a conclusion. Here we go. The conclusion is called the audit opinion. The audit opinion is included within a document called the audit report. Now, here's what I want you to make sure you note down. There are two types of audit reports, okay? So there are two types. Here we go. The first one, write this down, is called unmodified. Unmodified audit report, okay? And the other one is called modified. Okay, so we have two types. Now, to make your job a bit easier, what I want you to do is next to the word you've written, unmodified, I want you to do a smiley face. Okay? Trust me, it's going to help you. Next to the word modified, I want you to put a sad face. Now, let me show you the link. What happens is the auditor will determine their audit opinion and their audit report based off what their testing has told them, what the evidence has told them about whether the financials are indeed true and fair. So if they provide an unmodified audit report, this one here, the smiley face, what do you think that means? Do you think that means that the financials are true and fair or are not true and fair? If it's a smiley face. Are or are not? You've got two options. Fantastic. Okay, so if you want next to that, you can essentially write that an unmodified audit report means that the auditor believes that the financial report is indeed true and fair. It is a true reflection of what has happened in the business. Okay? A modified audit report, however, means that the auditor cannot conclude that. They cannot conclude that the financials are true and fair. They have either found something or they weren't able to reach a conclusion. And we're going to talk more about this soon. But for now, I want you to have that smiley face and that sad face and start getting familiar with this terminology, okay? So if you look at all of this and you now go back, coming over here, the financial report. Who prepares the financial report? It's not the auditor. Who is it? The accountants. Guys, write this down. It's management, okay? Management are the group of people who prepare the financial statements. Okay, so the financial report, I should say. Now, why is that important? The people, the individuals, the group or the body who prepare the information that the auditor is checking, they are called the responsible party. Write that down. They are called, bless you, the responsible. Who looks at this? Who relies on this? Who? Investors. Ladies and gentlemen, I want you to write one more word. Users. We're going to talk about this a bit later. But if you can, on top of the word users, write intended users. At the end of the day, when we provide our audit report or our audit opinion, The people who rely on that, they are called the intended users. Okay? So in our case, because our context is indeed the financial report audit, those intended users are indeed the investors. And we're going to talk more about that as we go along. That, guys, that's assurance. So breaking it down, really basic. You've got information that is prepared by someone, aka responsible party. You've got an assurance practitioner, aka the auditor, who comes in and evaluates that information against a set of criteria. They then come up with a conclusion as to whether that information is indeed correct. That's assurance, okay? The context that we will have is on a financial report audit. So what you see on the board, and yep, that looks great. What you see up there, that's basically what our focus will be, okay? So on that note, let's go to the next slide. What I want every single person in this room to do right now, I want you to highlight that word, independent. If you can, write it on top of your slide in big block letters, independence. Ladies and gentlemen, that is the most important concept in audit. The most important concept in audit. You're going to be hearing me say that over and over again. It is so important that any audit textbook that you open up will have the same one sentence. And that one sentence is, independence is the cornerstone of the audit profession. The most important thing in audit is independence. Why? Because the value of assurance, the value of audit, comes down to the fact that the person providing the assurance is independent. They're not biased. They're able to be objective. They're able to be impartial. Ladies and gentlemen, the definition of independence is not related to, not associated with, and not influenced by the information, how it was prepared, and the people who prepared it. So if the assurance practitioner is independent, only then can we rely on their conclusion. Only then will we consider their conclusion credible and therefore reliable and something that we can depend on. So everything that we do, the whole value of this process and this profession comes down to them being independent, okay? So there's actually two things I want you to write. There's independent and there's one more word. You can write this any way you want. Oops, sorry. Expertise. These are the two elements that make audit valuable. They are independent, number one. They have experts. They have the skill, the knowledge, the expertise, and the experience to do the job. They know what to do. They know what to look for. So they're not only independent, but they've got the right skill set and the right competence to give you a conclusion you can rely on. Okay? That's what it all comes down to. At the end of the day, why do we need information? What do we do with information, guys? What do we do with it? You make decisions. That's absolutely right. We cannot, well, let me say it this way. As long as there are people that need to rely on information to make a decision, as long as there is information they need to rely on to make a decision, there will be a demand for audit. Okay? Because having an audit done increases or enhances the quality of the information and therefore makes us rely on that a bit better. As long as there is that need, there will be a demand for assurance. And on that note, there are 3 levels of assurance. I'm just going to make this a bit bigger so you can see it. Okay, there are 3 levels of assurance. What I want everyone to do is highlight the word reasonable. The highest level of assurance we can provide, and by the way, we provide this whenever it's an audit. So any type of audit, we provide reasonable level of assurance. So make that link in your notes. Reasonable level of assurance, the highest level of assurance that we provide. Absolute highest. Now notice the word. The word is reasonable. The word is not absolute. The word is not guarantee. Because in an audit, we can never 100% guarantee that every single number and every single transaction is correct. Why? Think of the following organizations: McDonald's, IKEA, Woolworths. Are we physically able to go and check every single one of their transactions, yes or no? No. Bless you. Okay? So we cannot physically go and check everything. So what we do in audit, and I want you to write this down, what we do in audit is we take a sample. We take a sample and we test that sample, and it is based on that testing and that evidence that we reach our conclusion. So absolute assurance is not something that we can provide. The highest level is reasonable, okay? The highest level is reasonable assurance, and it's provided when it comes to an audit. The next level down is limited assurance, okay? Now I want you to do a line between limited and the word review. Whenever there is a review engagement, so remember, review is different to audit. How is it different? A review is a lower type of engagement. It's less comprehensive. So if you want, just write that down. It's like an audit, but it's less comprehensive. And because it's less comprehensive, the level of assurance we provide is limited assurance. So it's some level of assurance still, but it's not as much as the reasonable level. And remember, if it's a review engagement, it's limited assurance. If it's an audit engagement, it's reasonable assurance. We have one more, no assurance. No assurance means the auditor, or the practitioner, I should say, is not actually checking anything against criteria. What they're doing in this case is they're just performing a task like bookkeeping or doing a tax return on behalf of the client. That's it. So they're not doing the whole evaluating thing and coming up with a conclusion. Rather, they are just performing a task on behalf of the client. That is why it is called agreed upon procedures. And the best example of that is bookkeeping or tax returns, to be honest with you, okay? So there are 3 levels of assurance. One of them is zero assurance, and the other one is reasonable and limited. Reasonable is the one that we'll be focusing on because our focus is indeed on audit, okay? So attestation services. Now, I'll be very quick with this one. Attestation services basically means, and I'm just going to speed things up a little bit. Yeah, a lot. Attestation services is basically any assurance where the conclusion is communicated in written form. That's it. It's any assurance whereby the conclusion is communicated in a written document. So that's done with reviews, that's done with audits, and some other engagements. That's all you need to know, okay? So it's communicated in a written form. So the audit report, that makes it an attestation service. Now here are some examples. So you've got audits, you've got reviews, and you've got other. Again, remember, our focus will be on the audit of the financial report, okay? That will be our focus. Are we coming up with a conclusion about whether the information is true and fair, okay? Whether it's a true reflection of the business. Now, there are other assurance services that are also provided. You know what? Let me just say this one this way. You can basically assure anything. Let me give you an example of things that assurance services things that are assured that you might not be aware of. Lotto. Lotto is assured. If you actually watch the section where they do like the whole numbers and everything, there is a reference to the fact that either PwC or Deloitte or Ernst & Young or KPMG audited the results to make sure that it was indeed correct, that there wasn't any manipulation that happened. So that's something that is also assured. It's not just financial statements. It's not just something in a business corporation. So things like Lotto can be assured. You know what else is assured? All the competitions that require voting. X Factor, Australia's Got Talent, The Voice. All of those are also assured engagements. So it's not just restricted to financial statements. So be mindful of that. Now, these are some other examples that you can find in your textbook. Have a read of them. But essentially, I just want you to know that it's not just restricted to financial statements. And this is basically what I was saying before. Okay? So you've got assurance. So you've got assurance services and you've got non-assurance services. Assurance services is things like audits and reviews, anything that we're checking against criteria and coming up with a conclusion. Non-assurance is tasks that we're performing simply on behalf of the client, whereby no essential conclusion is given. Now, I've got a question for you. So I mentioned users. We mentioned users before. The question I have is, who are some users of the financial report or the financial statements? Who do you think? Excellent. Suppliers, okay. Suppliers, good. What type of decisions will they be making based off that information? Excellent. Should I sell them products? Will they be able to pay me back? Awesome. What else? Who else, I should say? Banks, awesome. Okay, banks. What are banks caring about? Exactly. So if a company is coming to the bank and they got a loan from the bank wants to be able to see some financial statements, some audited financial statements, to get comfort that they're going to be able to pay me back. Someone said customers. What do we care about customers? Well, why do customers care, I should say? What do you think? Yeah, that's true. So whether it could also be whether the business is going to stay in business so they can keep on buying their products from there. It's really funny that the major one hasn't come up yet. Competitors, who else? Shareholders, investors. Okay, I'll do that as a big one. Investors. How did that not come up? Investors. Let me ask you this. What decision do investors want to be making? Buy, sell, or hold. Okay? Should I buy shares in this company? Should I sell my shares in this company? Or should I hold my shares in this company? Okay? So these are all types of users, people who are going to rely on this information in order to make decisions. By the way, I actually included them all there. So there you go. And it includes types of decisions that they want to be making. Well done, guys. Now, on that note, I want to ask you this. Actually, I want to tell you something. So the demand for audit, why do we have audits? You can answer that question based off two perspectives. The first one is the perspective of business, and the other one is the perspective of users, so people who are going to use that information. From the perspective of business, when you ask them, why do you have an audit done, there are essentially two views that they have. The first view is this. Well, I engage an auditor because I have to. Under the Corporations Act, every single every single company listed on the ASX must be audited at least annually. Write that down, at least annually. Okay, when I say at least annually, they can also have their half-year results audited as well, but it has to be at least the annual one. So from the perspective of business, why do they get audits done? Well, number one, the viewpoint is, well, I don't care for it, I don't see the value in it, but I have to do it. It's a mandatory obligation. The other view from business is they see the value in audit. Do you know why? They see the value in audit in the sense that it acts as a signalling mechanism. It sends a signal to investors. And that is actually why some organisations, some companies that don't legally need to be audited still get audits done. Because it portrays an image. It sends a signal to investors that, hey, I've got nothing to hide. I didn't need to get an audit done, but I still did. Okay? It sends a signal. And remember what we were talking about before. When an independent person who has the expertise, the two key concepts that underlie the value of audit, independence and they have the expertise, when someone that is independent and has the expertise checks something and gives you a conclusion as to whether they think it's correct, it enhances your confidence in being able to rely on that information. So this signalling thing is actually very important. So from the perspective of business, this one's actually a much more common view that businesses have. It actually is valuable and investors will appreciate it. Now moving on to users. At the end of the day, users want good information in order to make good decisions. As businesses grow, as businesses expand and become more complicated, it increases the risk of what is called information risk. Highlight that for me, okay? Information risk is the risk that the information is wrong, okay? It's the risk that the information is wrong. So users, people that want to rely on information, they want to deal with this risk. So how do they do it? Before we go through how they do it, let's look at the causes of information risk. Why is it even there? Number one, remoteness of information. I would explain this in a slightly different way. There is now a separation between the owners of a company and the managers of a company. Who are the owners of a company? Shareholders, fantastic. Are those the same people who run the business on a day-to-day? Yes or no? No. So because of that separation, there is now a very physical remoteness between those two groups. So owners, users, people that want to use that information and rely on that information to make decisions don't have the ability to physically go and access that information themselves. So think about it this way. My dad owns shares in Woolworths. He doesn't know what shares are, but he owns them in Woolworths. Can he go to Woolworths headquarters in Bella Vista, knock on the door and say, hey, can I just look at your accounting information? Can he do that? That would be weird if he could do that, but he can't, and that's what remoteness of information means, okay? They don't have access to it themselves. Second one is, this is a really important one, and I want to do this one in red. Biases and motives of the provider. Ladies and gentlemen, please write this next to it. Agency theory, or agency problem, whichever one you're more familiar with. This comes back to what we just said, the separation between owners and managers. Because of that separation, managers know what's happening in the business, owners don't. So owners need to essentially rely on managers being truthful with them. Now, what this particular cause of information risk is saying is that, well, what stops management from manipulating the information to suit their own interests to the detriment of the owner? Let me give you an example. If you watch the welcome video, this was an example of it. Management wants to stop them from overstating sales, and by overstating sales, hitting their sales targets and getting their bonuses at the detriment of the owners, because it's essentially incorrect information that's being portrayed. That, in a sense, is agency theory. Okay, and that's a big problem because owners sometimes, and I don't like to say that you can't trust management, but sometimes they can't trust management because management has self-interest. Sometimes they can do things, behave or make decisions in a way that does not benefit the owner, so that's an issue. Then we've got the volume and the sheer complexity of information these days. Guys, now more than ever before, we've got more multinational organisations than ever before. We've got international transactions that include different currencies, they include exchange rates. We've got really complicated products, more so now than ever before. All of these things lead to complexity. All right? Now, that's a problem for two reasons. Number one, complexity means it's very difficult to understand what's going on. Number two, you have people now investing. You've got shareholders. We call them mum and dad shareholders, right? Because they don't really know anything about accounting. They don't have the skills or the knowledge to be able to look at a set of financial statements and go, oh, yes, that's what it means, right? So because of this, they almost need to have, someone who, again, bring it back, who is independent and who has the expertise to look at the information, come up with a conclusion that gives them comfort that, okay, I can now rely on this information. So these are the main causes of information risk, and the main way that that users reduce that information risk, or a better word is mitigate that information risk, is by having the financial reports audited, okay? That's how they do it. That's the link. So they can go ahead and verify the information themselves, but again, that's very unlikely to happen these days. Like my dad can't go to Woolworths and knock on the door. It says, the second one says, users share information risk with management. Now, the only thing that's trying to say to you is this: management has a duty. Management has a duty to present true information. So if they're found to have breached that duty, then they can be found liable. But again, that won't really benefit the user themselves financially, but that's still something that can happen. The key one is getting audits done, okay? I'm just going to speed things up a little bit. Now, there's no awe in the crowd? Okay. So this, I don't know if any of you know who Amanda White is, but this is Amanda White's son. The first son. She's actually away now. She just gave birth to a second son. But the reason why this picture is there is, read this. Is this the world's cutest kid? That is the question. Now, I've got a different scenario that I'm going to present here. Who's heard of bonds? Like the underwear, the clothes. Who's heard of them? Stand up. Half the group. The rest of you haven't heard of bonds. Interesting. Okay. Bonds has a baby photo competition from time time to time. And the baby photo competition, the aim of the competition is so people send in photos of their kids and they're going to pick the cutest kid, and the cutest kid becomes essentially the face of Bonds in their advertising. So that's what the competition is all based on. Now, do you have a point? The point is this. Every mother thinks that their kid is the cutest kid in the whole entire world, right? On Facebook, oh my God, my baby is so cute. No, it's not. That baby looks like an alien. But every mother is, oh my God, my baby is so cute. So in that case, ladies and gentlemen, you don't like that? I'm sorry. Your baby is cute. I promise. In that situation, is the mother, can we trust the mother's judgment? Yes or no? No. Okay. So we need someone to, like I said, it's very rare to find a mother who looks at their kid and goes, yeah, I don't know. Like, I don't know what happened. I blame the father. Okay? So we need someone to judge that competition, someone who is independent, doesn't know any of the families, doesn't know any of the babies, isn't receiving any bribes or anything like that, so we can trust their conclusion. Okay, so we can trust their conclusion. We can put our value in what they come out with. Guys, that's what we're doing in audit. We're objectively looking at the financial report. We're comparing it against the criteria, and we're collecting evidence to ultimately come up with a conclusion about whether it is indeed true and fair. Okay, it's because we are independent and we have the expertise that underlies the value that we provide, okay? And that's what we're essentially talking about audit. So if you go through this is what we're talking about. You've got auditor coming in, checking the subject matter against criteria to come up with that conclusion. So this is essentially what we've been through. These are the main elements. So we've got information. Guys, on top of that, don't write information. On top of that, can you please write subject matter? Let's start using the correct terminology, all right? The information we're looking at is called subject matter. That is the correct terminology. We are comparing it against criteria, okay? In our case, the criteria was the AASBs, the Accounting Standards. We are collecting evidence, so we do testing and we collect evidence in order to base our conclusion on. Now, we have a ton of evidence gathering techniques that we use in different processes. It's like CSI, just less cool, okay? So I tried, but you know, it's an uphill battle. We'll go through all the different types of evidence collection. It comes down to the person being independent. It says here competence. Competence is the same as kind of having the expertise, having the skill, the knowledge, the experience to do the job. And finally, coming up with a conclusion in our report. Now, let's just see how much you remember. Which one's the good report, the smiley face report? What's it called? Excellent. What's the other one called? Beautiful. All right, good. We're going to keep making references to that throughout the entire course, and we're going to talk about it a bit later at the end as well. Fantastic. Okay, with the report, I want to show you that audit is valued and there's proof that audit is valued in society. So I'm just going to do it this way. All right, this is the share price of a company, okay? So it's at whatever this number is, okay? Now, if the company, it was audited, the financial report was audited, and the auditor provided an unmodified audit report, unmodified, the smiley face one, right? What do you think happens to the share price? It goes up, write that down, okay? It goes up. That's why it's a smiley face, okay? What do you think happens if they give a modified audit report? Beautiful. Ladies and gentlemen, that proves, and by the way, this is a very general thing, sometimes there's differences, but that proves that the market values audit, okay? Now that's a good thing and a bad thing, and we'll talk about it later, okay? But that's proof that they do value. Now on that note, there was something I was going to tell you. I'll come back to it later. No, I'll do it now. Yeah, let's do it now. Yeah, okay. Sorry about this, go back for a sec. Josh, did you have a question?
Wouldn't you expect in an unqualified opinion, the market already sort of assumes what the data's going to be. With the financial report coming out, you expect the market to be like, okay, the auditor's ticked, my investment's safe, but it's more like if they gave a qualified opinion, you expect it to go down, whereas unqualified, you really wouldn't expect much movement
Great question. Okay, so he's basically saying that wouldn't the default be that it's got to be true, and it's only when it comes up with a modified that the price would go down? No. Okay, because it comes down to independence and expertise, right? At the end of the day, management prepares the financial report. Management has self-interest in potentially manipulating numbers to personally gain from the matter. So even though, yes, you would expect that the default would be that the numbers should be true and fair, it's only once that is kind of confirmed by someone who's independent and who has expertise to confirm it, that the market goes, okay, we're good, and it goes up a little bit, right? Now, the extent to which it goes up, this is interesting, the extent to which it goes up is less than the extent that it goes down in the event of a modified one. Okay, so that's an interesting thing to think about. Again, I'm just showing you that it is clearly, it is. I'm going to go quickly through the next ones because you can just read these. There's no value that I can really add here. The difference between auditing and accounting. Ladies and gentlemen, accounting, as you know from all your studies up until now, it's all about recording and preparing information, right? Your debits and your credits, your trial balance, your financial statements. Okay, so you're recording all the transactions, you're preparing the financial statements. The difference between that and auditing takes us to the next level. Auditing is about checking the information and analysing its correctness. Auditing is about interpreting the information and the audit evidence. So it's another skill, okay? Now let me explain it this way. All auditors are accountants. All accountants are not auditors. Next level, okay? And that's what I've been telling you from the welcome video up until now. Audit is going to take your accounting knowledge to the next level. You need to have that basic knowledge if you're going to do well in this subject. And that is why, if those of you that have already been to the tutorial, you've already done the first quiz. The rest of you, you're going to do an accounting quiz in your first tutorial. It's not accessible, but it's going to give you a good indicator of the basic knowledge and whether you are lacking a little bit or not, okay? So it's the basic stuff that you really need. Okay, we have different types of audit. Like I said, our focus will be on the financial statement audit or the financial report audit. Another one is performance audit. Now, this one's interesting. A performance audit focuses on checking whether the body or the information or the group that we are checking, whether they are operating effectively and efficiently. Okay, they're the key words, effectively and efficiently. So let me just give you context. Let me give you an example. Performance audits are done for government bodies. Why? Because government bodies have a budget. And we do performance audits against them to make sure they are effectively and efficiently utilising their budgets. Another group that have performance audits, non-for-profit organisations. Even though their main priority is not to make profit, people are giving them money. So the people that are contributing funds to these non-for-profit organisations, these charities, want to make sure that those funds are being used effectively and efficiently. Those funds are being used appropriately as they were promised, okay? That's a performance audit. The last one is a compliance audit. Now, the name kind of gives it away, but a compliance audit is when we are checking to make sure that the information complies with certain rules and regulations. Best example, write this down, is a tax audit. So when the ATO randomly picks people and conducts audits of their tax returns, they are checking to see if those individuals have correctly included all their assessable income, the ones that they should have included, and the claims, the deductions that they have claimed are deductions that they could have claimed based on the tax rules and the tax regulations. All right, so that's the best example of that one. What's our focus? Which of these three is our focus? The first one, okay? I want you to know all of them, but our focus will be on the first one. That's our, again, next. So here's just some more information about them, so you can read of that. We have different types of auditors. The first one is the public accounting firms, aka your big four, your mid-tier firms, your private accounting firms. They all sit in that first category. Now, interesting point to make on that is they need to be registered under the Corporations Act. Can you please add this to your notes? With ASIC. So we get registered with ASIC. Under the Corporations Act, these public accounting firms must be registered with ASIC in order to provide audit services. The next group are the officers serving the Auditor General, the auditors who are involved in auditing government bodies. Okay, so government body can be like Centrelink, for example. So you've got auditors focused on just just auditing government bodies. Let me ask you a question, see if you got it. What type of audit is conducted here with government bodies? What's it called? Say it again. Beautiful. Performance audit. Write it down. Here's your link, okay? You're linking this section to what we just talked about. Performance audit. Good. Next one, you've got tax auditors. As the name suggests, the auditors that audit your tax returns. Now, what type of audit was that? Say it again. Yes, compliance. Link it back, okay? Good. And then you've got internal auditors. Now, this one's interesting. It's very interesting because people don't realise we have such a thing as internal and external auditors. I'm like 10 minutes behind, so I'm going to do this very quickly. Let me give you context. Let me give you examples. So when I worked at KPMG, one of my biggest clients was IAG. So IAG, if you know NRMA Insurance, IAG is like the mum of NRMA Insurance, or parent, as they technically call it. Now, I was employed by KPMG. I went to IAG and did an audit. In that situation, guys, I'm an external auditor. I am hired. I have a salary coming from KPMG. I'm going into the client as an external person and conducting an audit. External auditor. Internal auditors, guys, are employed by that company. Okay, so let me give you an example. When I worked at Johnson & Johnson, I worked in compliance. I was an internal auditor. Why? I was employed at Johnson & Johnson to audit Johnson & Johnson. Okay, that's an internal auditor. Now you might be thinking, how are you independent if you work for them? The way that you're independent is because you do not have access to any of the systems, any of the tasks, or any of the processes that you are auditing. That's how you gain your independence, okay? But the difference between internal and external essentially comes down to who pays your salary, if you think about it, okay? And we're going to talk more about internal auditors a bit later on. So I just wanted to make that distinction for you. All right, very quickly. Public accounting firms, we've got the big four, we've got the mid-tier firms, we've got the little mum and dad company businesses as well. So you've got your big four, which are these ones there. So I worked at KPMG. We've got the mid-tier ones over here. Now, Grant Thornton, so if you have Nicole or Kate as your tutors this afternoon and this evening, they work at Grant Thornton. If you had Ben this morning, he works at a smaller organisation that does smaller audits. So on that note, audit can be done for any size organisation. The smallest audit I ever did was on a charity. It took 3 days. The biggest audit was IAG. I spent 11 months out of the year at that place, okay? Oh, I still have the dreams, okay? So you can have all types in that. And I just want to add something to that. So what's really interesting that's happened more so now is that audit firms are starting to become specialised. What do I mean? They will specialise because there's so many different types of businesses and so many different industries. They become specialised where they focus on a certain industry or a certain type of business. Or they separate into departments with, so for example, KPMG, audit was split up into different areas. So I was in insurance. There was also a bank area. There was also property, whereby those individuals in that group, in that department, focused on auditing those types of clients. So I was in insurance. So all of my clients since that time were all insurance companies and reinsurance companies. Do you know what reinsurance is? So you know insurance companies, they also have insurance companies. So the insurance companies, they insure the insurance companies, that's called reinsurance. So it's interesting. Anyway, I digress. One of my friends was in the bank department. So he would audit banks. So probably the best story he ever told me was he had to go and count money in a safe in a bank. And so before he could do that, they gave him a onesie. It was a white onesie, no pockets, right? So he would count the money, but he wasn't like obviously to take any. But I thought that was pretty cool. Anyway, one for you, one for me. Okay, now auditors, I should say, they provide audit services as well as non-audit services as well. This is going back to what I mentioned at the beginning. There's assurance services and there's non-assurance services, okay? KPMG, Ernst & Young, PwC, which one did I not say? Deloitte. They provide both, okay? You know why? Because the money's with this one. The money is with non-assurance. Audit's actually not very profitable, believe it or not, because so much manpower goes into doing it, okay? So they actually provide both. Now, the only thing they need to be mindful of is if there's any conflict of interest between them. So we can't, for example, we can't help them prepare the financial statements and then turn around and check the financial statements, okay? Because that's a conflict. And we're going to talk more about that next week. There are different structures. So now most auditing firms, most accounting firms I should say, they have a company structure. Why do you think that is? What is the most valuable feature of a company? LL, limited liability. That's exactly right, okay? So even though you'll hear us say things like there's an audit partner, it doesn't mean partner in the sense of a partnership. It's not in that technical sense, okay? They are companies because of the key being limited liability. Now the hierarchy, how does the hierarchy work? This is interesting. We've got audit partners. They are basically the big boss. Then you've got your managers, your senior managers and your assistant managers. Then you've got your seniors. Then it says here supervisors. We actually call them in charges. So they're in charge of the audit essentially. Then you've got your juniors. Don't really call them that. We call them either grads or cadets, okay? Cadet if you're still at uni, grad you're out of uni. Now, the reason why this hierarchy is important is because when it comes to review, each level, it goes up those levels. So the works of the juniors, the cadets and the grads are checked by the seniors. The work of the seniors are checked by the in-charges. The work of the in-charge is checked by the manager, and then the partner looks at a file while having coffee, okay? So that's basically how it works. Why is that important? Quality standards, okay? We need to make sure, actually let me give it to you this way. The audit report, the document provided at the end of the audit, ladies and gentlemen, is a legal document. So if we are found to have missed something, if we are found to be negligent, keyword I'm going to be talking about next week, we can be sued, right? So we need to make sure that we uphold very high quality standards to ensure that doesn't happen. Okay, bless you. Now, there are two main bodies, two main professional bodies, which are CA and CPA. You need to have qualifications in terms of educational qualifications as well as professional experience to gain membership with those bodies. Auditing standards, I'm just going to speed things up because I need to. ASAs are the Australian standards of audit, so the Auditing Standards of Australia. They are what we will be referring to throughout the course of this subject because they essentially guide how the audit should be done. I mentioned this to you all last week. There is a listing of ASAs that I have created for you. It is on UTS Online. That is what you need to download and keep as part of your study material. We will be referring to ASAs throughout the course of the subject. The ASAs have force of law. They are legally enforceable. And they, as I said, they guide this in how it should be done. I mentioned this already, quality control is incredibly important. We need to make sure we maintain high standards of quality because at the end of the day, we provide a legal document, okay? We'll talk more about that next week. Now, the final thing I'll mention here, one thing that we do as part of quality control is peer reviews. Peer reviews happen within an organisation as well as between organisations. What do I mean? Within an organisation, go back to that hierarchy I just referred to. Work of juniors gets checked by seniors. Work of seniors gets checked by managers and so on and so forth. So within the company or within the business. That also extends to one partner can check the work of another. It can also happen between organisations. So we can have a PwC partner coming in and checking the work of a KPMG partner in terms of the audit that they conducted. So we have that. Why? Again, comes down to quality, okay? Making sure that we've got, everything is being done the way it should be done. CA and CPA also engage in peer review, so they'll go and they'll check audits that were conducted. And the other thing that I'll just mention is ASIC. ASIC also does random inspections to make sure that audit firms are doing the right thing and are obeying the ASAs. And if an audit firm is found to have done the wrong thing, they get fined, okay? So that's an interesting thing to note. Well, Corporation Act is the last thing here before we go into the audit report. Corporations Act, guys, is the most important it's the most important business law in Australia for companies, okay? Now, it actually sets down some guidelines as to how an audit should be conducted, including, I told you this before, every single publicly listed organisation, publicly listed company must be audited at least what? Annually. Excellent. At least once a year. That's set down in the Corporations Act. Another thing that's set down in the Corporations Act is that auditors must be registered with who? ASIC. Fantastic. Good. The other thing that it sets down, and this one's interesting, it tells you how long the audit information, the audit files, need to be kept. How many years do you think we need to hold on to the information? 7 years. Damn it. Yeah. 7 years. 7 years, write that down. So the retention, which is how long we have to hold the document, 7 years. And that's set down in the Corporations Act. I'll just mention 2 more things. First one is, write this down, it also sets down the requirement to have what's called audit partner rotations. So you know how I said that the boss of the audit is the audit partner? The Corporations Act says that an audit partner cannot stay the audit partner of a client for more than 5 consecutive years. So out of each set of 7 years, an audit partner can only be there for a maximum of 5 out of those 7 years. So they'll be there for the maximum of 5, they'll have to go off for 2, and then they can come back. It's called audit partner rotations. In Australia, that's a requirement. In America, the whole audit firm has to rotate. So they basically have to give up the client, move on, and then come back later. All right? There are reasons for this, and we'll talk about them more next week. But basically, I'm just going to mention this concept to you. It's to deal with, can you write this down? Familiarity threat. Familiarity threat. You don't want the audit partner to become too close to the client, because if you become too close to the client, independence then comes into question. And that's the key theme we're going to be talking about next week. Guys, just heads up, next week is really, really, not intense, but there's a lot of information. All right, so grab a coffee before you come or something, all right? Final thing I mentioned here is, just because it's interesting, no, I'm going to move on. I'll mention this thing next week anyway. Remind me, tell me where everyone that I used to work with, where they are now. Ask me that. They're all alive. Like, this isn't a sad story, but like, I'll tell you, it's interesting. Let's move on. Audit reporting, one more time. What was the happy face report? Excellent. Unmodified. Good. What was the sad one? Good. Excellent. You're doing really, really well. Now, the audit report at the end of the day is a legal document, hence why we have so much focus on quality standards and things like that. We don't want to get sued, which is essentially the topic of next week, legal liability. So, the first one is, I'll just say this very quickly. We now have, it says here, the profession, undo. Highlighter. The profession recognises the need for uniformity in reporting. Guys, uniformity means consistency. We now have audit reports. Any audit report you look at, you'll notice looks almost exactly the same as every other audit report. Why? We have templates. Okay? So the audit reports, it's all about consistency. So they're all very similar, except those parts of the audit report that are talking about something specifically about the client. The rest of it is quite standard. Now, on that note, we've got the first one, which is an unmodified audit report. What I would like everyone to write on their notes right now is an unmodified audit report can also be called an unqualified. You might have heard this term. An unqualified audit report or an unqualified audit opinion. Ladies and gentlemen, it's still the good one. It's still the good one, okay? It means that we have looked at the financial statements and we have concluded that indeed it is true, where is it? It's true and fair. It's free from material misstatement. Now, very quickly, next to the word material, I want everyone writing this one word, significant. Write that down, significant. Something, when it is deemed to be material, it means it is deemed to be significant. Significant enough to make mention of. And we're going to talk about that concept later on. The other thing that it says there is misstatement. Ladies and gentlemen, misstatement means the information is wrong. Now, notice what it says next to it. It says either due to fraud or error. Why is that important? Fraud is intentional. Error is a mistake. It's unintentional. Why does it say either? Because we don't care if it was intentional or not. If it's wrong, which means it's not true and fair. Okay, so just be mindful of that, and we will be focusing on this as we go along. So when I say it's true and fair, what we're basically saying is that it is free from material misstatements. It is free from significant information that is wrong. Okay, significant. So if there's a $2 mistake somewhere, that's okay. It's not going to mess with our opinion because we're focused on the significant issues. All right? So it applies to the accounting standards and it's a fair representation. Now, this is what it looks like. The audit report looks like this. Got 20 minutes. Should be okay, Lydia. It looks like this. This is a structure. Remember what I said, uniformity. So it's a standardized structure. It starts off with the title, the address, and then you hit the audit opinion. Now, you'll notice I've added this note. I'm just going to make this bigger. Oops. I've added that note. Why? Because ASA 700 has been updated. So your textbooks will not reflect this. So please be mindful when you are reading your textbooks that there is a slight update that you need to be mindful of. So the auditor's opinion used to be at the very bottom of the report and now it's right up there at the top, which is interesting because it should have been there in the first place because it's the most important piece of information. But it used to be at the bottom. So they put the audit opinion as well as the reason for their opinion at the top. And then there's this new element under ASA 701 called Key Audit Matters. Now, I'm just going to mention this now. There is a slide on it later, but I'm just going to mention it now since we're talking about it. There's a new standard that is effective from the 31st of December last year, so now it's effective. Last semester it wasn't. And basically what it says is that auditors must now disclose in their report extra information about how they got to their final opinion. What do I mean? There are areas that when we do audit, and you're going to see this as the weeks go by, there's actually a lot of judgment that we use. It's called professional judgment that we use when we come to auditing. So in those areas that are highly complicated or where we've exercised a lot of judgment, we need to actually sit down and explain how do we get to that conclusion. It's all about keyword transparency and holding the auditor accountable for the decisions that they make and the judgments that they pass. So that is ASA 701. There is a reason it is there. Just going to pause for emphasis, okay? So key audit matters, they do need to include that as well. Okay, now then you've got the rest of that information. Please do remember that this is different from your textbook, particularly when it comes to ASA 700, so just be mindful of that. Remember something, I've already started telling you about ASAs. ASA 700, ASA 701, and next one. Guys, just talking about now, we now focus on this. This is important because it's slightly off. Okay, this is really important because this is all about the modified report. The sad face one. Okay? Basically what is being said here is that we cannot conclude that the information is true and fair. We cannot conclude that the information is free from material misstatement, whether either due to error or fraud. Now, first things first, actually, can I just go back just 1 minute, is ASA 705, all right? So the ASAs, the auditing standards, are now in play. Okay, you're going to see these as we go along. I usually try to make them in red just to kind of highlight them to you. But ASA 705 deals with modified audit reports. Now, what happens here, and this is what I want you all to realise, is that there's a difference between the distinction of audit report and the concept of audit opinion. An audit opinion, guys, sits in the report. Okay? Now, when it's a modified report, you have 3 options of opinions. 3 options. Look at the boxes. You got qualified, adverse, and disclaimer of opinion. So they are the 3 types of opinions that sit in a modified report. So I'll make this clear as the weeks go on, but I just want to kind of make that noted. Okay, so how do we know which opinion to give? You use this box. This is your guiding box. I'm just going to focus on this a little bit. Where is it? 1 moment. Okay. Oh, that's it? Okay. So the first thing you do is you realise that you cannot conclude that it's true and fair. So what you need to do as step number one is look at, well, what's the reason why I can't conclude that it's true and fair? You've got two options. The reason is either that the financial report is materially misstated, there is an error or a fraud in there that is significant, or, and listen to what I say very carefully, or you weren't able to collect evidence. There's a difference. In the first one, you collected evidence and you realise that there are mistakes or there's fraud, which is significant. In the second one, you weren't able to collect the information in the first place. You weren't able to collect the evidence in the first place. Let me just give you an example. There was a fire at the warehouse, destroyed all the material, destroyed all the inventory. There was a fire at the headquarters, destroyed all the records. So there was no information or there was no evidence for you to evaluate and base your conclusion on. So you have to see which of those two are the main reasons. Once you've got that, comes down to one word, and that is pervasive. Okay? Pervasive. When you see that word, can you please write down the way that I best explain this is write down widespread question mark. Widespread question mark. If the issue is that you found a misstatement, right, an error or a fraud, any information that's wrong, the question then becomes how severe, it says at the bottom, how severe, depends on the severity of the issue. How severe was that misstatement? I don't want you to think about severe, I want you to think how widespread is the issue. Is the issue restricted into one account, like inventory? Or is it in many different accounts? Is it an interest expense, and accounts receivable, and cash, and plants and equipment, and accounts payable? Widespread means how far does this issue go? Is it impacting a lot of different accounts, or is it just restricted to the one? If it's restricted to the one, guys, it is not pervasive. If it's in many different areas, that's pervasive. If it's widespread, that's pervasive. The best way, and this is why you see the images there, I think Amanda came up with this, the octopus. If you put an octopus on the financial statement, its tentacles touch different accounts. That's pervasive. That's pervasive. It's widespread. It's impacting on many different areas. Notice the word I just said. I said different areas. Different areas. And I'm going to emphasize that later. Otherwise, the other one is a slug. If you put a slug on the financial statement, it doesn't move too much. So it's restricted to that one area. That means it's not pervasive. So sometimes the visuals will help you along the way. Okay? So depending on which combination, you will get to what the conclusion should be. So let's do this very quickly. So if the information is indeed materially misstated, so there is an issue, but the issue is only restricted to one account, what's the opinion we should give? What is it? Go in the box, go in the box. So look at something on the left and something on the top. Go to the middle of the box. What's our answer? If there's an issue, a material issue, but it's restricted to one account, what's your opinion? Excellent, well done. It will be qualified, excellent. That's how you use this box. Let's do this one more time. If that issue, actually let's do it two more times. If the issue was that there was a fire in the warehouse and all the inventory was destroyed, so I actually can't see any of it. First of all, is there a material misstatement? Or is it inability to collect evidence? All right. Now, with inability to collect evidence, you're now sitting on that bottom line, okay? You still have to ask yourself that second question. How severe is it? Is it in one account or is it in multiple accounts? If the warehouse burnt down and it had inventory in it, is it going to impact just one account or multiple accounts? Mainly one, which means what's our answer? Excellent. If the fire was not just in the warehouse, but it was also at headquarters, so all the accounting records were destroyed along the way, then that would mean inability to obtain sufficient evidence, and it was pervasive, so you give what we call a disclaimer of opinion. Disclaimer of opinion literally means I can't give an opinion because I don't have anything to base it on. That's what a disclaimer of opinion means. All right? And the only other one is pervasive. Pervasive means that there's an issue, there's a significant issue, and it is everywhere. Not everywhere. It's in multiple places, okay? So that's the adverse one. That's this one here. Now, if you can, you know how we were saying that this is modified? So when you look over here, that's kind of like the qualified picture. So the sad face is the qualified one. The adverse, if they get adverse, it's like that. Like it's really bad, okay? Go back to what we were talking about with the share price. If it's qualified opinion, what happened to the share price? Qualified. Down, good. What do you think happens if it's adverse? Yeah. Okay? Not many companies survive an adverse opinion because that's bad. That is bad. That means there are significant issues in multiple areas. So basically, do not rely on these financial reports. That one's a really bad one. Okay? Good. Well, I'm going to... Lydia, I don't think it's going to happen. I'm sorry. So Lydia was going to do a presentation for you in the last 5 minutes. I don't think we're going to get to it, so I'll make sure I put it up on UTS Online. Make sure you have a look at it. It's a really great competition that Microsoft has on at the moment. So, yeah, have a look at it. All right. So next one, there's only 2 more things I really need to talk about. This one is called emphasis of matter. Now, let me explain this in this way. First things first. ASA 706, that's your reference in this one. And I'm just going to explain it to you in this way. Go back to your unmodified or unqualified audit report. Go back to what we've been talking about there. So unmodified or unqualified. Now, when we give an unmodified or unqualified report or opinion, you know what I mean, this happy one, we're basically saying it's true and fair. Okay, we're saying it's true and fair. It's free from material misstatement. However, in certain cases, there might be some piece of information that we think is so important that we want to emphasize to the people reading the report. In order for us to do that, in order to emphasize that extra piece of information, we provide what is called an emphasis of matter paragraph. Now, I'm not a big fan of how it's been worded on this slide. That's why I'm explaining it in a different way. So it's an emphasis of matter, an EOM paragraph, okay? So we include that as part of our audit opinion, or our audit report, I should say. And basically what we're doing is we're adding a paragraph and saying, hey guys, this information has been included in the financial report, but we think it's so important that we just want to highlight it for you. And we do that using what is called an emphasis of matter paragraph. Now you might be thinking, okay, well, when would you do that? You would do that in these instances. Okay? Probably the most important one I just want to focus on is that. Going concern issues. If the business has going concern issues, remember, actually, let me ask you a question. If a business is a going concern, is that a good thing or a bad thing? Let's do a vote. And you all have to vote. Okay? It's not accessible. You'll be okay. I just want to know who knows and who doesn't. Raise your hand if you think that a going concern, if a company is a going concern, it's a good thing. Raise your hand. And don't let peer pressure affect you, man. All right, raise your hand if you think it's a bad thing. Okay, can we please write this down? Going concern, if a company is a going concern, it means they are going to continue operating into the future. It's a good thing. Write that down, everybody. So a going concern is an assumption that the business will continue operating into the future. I know the wording kind of messes you up a little bit, but it actually means that you think the business is going to keep on operating. It's a going concern. It's going to keep on going. Think about it that way. Keep on going, okay? It's when there are going concern problems, that's when it means that we have concerns over the business's ability to keep on operating, okay? So when that happens, when there are going concern issues, the the Corporations Act says that the company must disclose those issues in their financial report. So let me just give you an example. If the business is continually making a loss, like every year they're making a loss, then at some point you've got to think, well, you're making a loss every single year. Like there are issues with your ability to keep on operating. That's a going concern issue. So the company must disclose that in their financial report. If they do that, that's pretty important. We want users, people that are relying on the financial report, we want them to know, we want to highlight the fact that, hey guys, just be mindful, they've included the fact that there's going concern issues, but we just want to highlight that to you so you're aware of it. That's when we use an emphasis of matter paragraph, okay? So it's, and now listen to me very carefully here, because you'll have something else. Information that is already included in the financial report, if it's already in there, but we want to highlight it to the users, we use an emphasis of matter paragraph. So it's already in there, we're just highlighting it, okay? Listen to me very carefully because your textbook will tell you this. There's something called an other matter paragraph, and that is used when the information has not already been included. That's the distinction, okay? So if the information has already been included in the financial report and we're emphasizing it, it's an emphasis of matter. We're emphasizing it. If the information was not included and it's just extra stuff we're including, that's an other matter paragraph, OM. The one that you will really just need to know is the emphasis of matter, but because your textbooks will make reference to both, I just wanted to make that distinction, okay? So emphasis of matter is something already there which we are emphasizing, and other matter is something that is not there, okay? And we're just adding as well. So that's that. And the final we're going to talk about is ASA 701. And I've already mentioned this. It is a new standard. It came into effect on the 31st of December 2016, though some companies did take it on board sooner. And again, like I said, it's all about increasing transparency over the auditor's decision-making by making them or requiring them to disclose further information about how they got to their audit decisions, how they exercised their professional judgment. So that's the only thing I really need you to know. The next two slides are just extras of ASA 701, so you can have a read of it for more detail. But that's a new, completely new standard. So guys, please know, this is not in your textbook, okay? So this is the only resource you have about ASA 701. So please make sure you do keep it in your studies guide. And finally, just give me one more minute before I let you go. I've got 2 minutes left on the clock. Your weekly in-class quizzes start next week in terms of being accessible. So in your tutorials today, you will get a chance to actually see how Learning Catalytics works. It's not that difficult, but please make sure you have your account set up, ready to go when you're going into the tutorials. That's really important. Guys, hold on, give me 30 seconds. Please make sure you have created your Learning Catalytics account using your UTS email. If you do not use your UTS email, I don't know who you are. My system won't talk to that system. Please make sure you create it using your UTS email. If you have not, you can go back and change it. All right, finally, make sure you take your device to tutorials and any notes as the quizzes are open book. Well done, guys. I will see you next week. Good job. Thank you very much.